Hi everybody, Aaron Fragnito here, back again with another video from People's Capital Group. Today we're going to talk about the value add of value add. All right, so when you look at an apartment building, we buy apartment buildings every 3 to 4 months. When you're looking at apartment buildings, you're looking at value add strategy, okay? Ways you can increase the cash flow of the building, increase the NOI, okay? So you want to increase the NOI, the net operating income. All right, if you can go ahead and increase the net operating income of a building, you can increase the value of the building. You can increase the value of that commercial real estate. That's why we like buying commercial buildings over residential properties like 2 families and single families. If you buy, fix, and resell or try to refinance out of a residential single family property, you're at the mercy of the markets, okay? If the markets drop out, comparable sales are not strong in that area, you're not going to appraise well, you're not going to sell for a good price, and you are at the mercy of the markets. When you buy commercial real estate, your value is based on your net operating income, okay? Which means how much cash flow can you get out of that property? How much can you lower your expenses? How many other ways can you find to make income on that property? Therefore, get the net operating income up on the real estate, okay? And there's numbers of ways to do that, and you want to check out our videos about that. But today we're going to talk about the value of value add. All right, so when you're looking at real estate, this is a little more in depth. We're taking a dive into the second rung here of real estate investing. When you're looking at real estate and you're saying, wow, like this building, for example, here is priced, let's say, at somewhat of a retail price. However, the rents are way below market value by 25-30%. So this landlord, for whatever reason, hasn't been doing a very good job of maintaining the building and maintaining rents, and just hasn't put them up to where they could be. Maybe there's a little bit deferred maintenance, but for the most part, it's just a management company or landlord that's not very aggressive with rent increases and could get more for the units, especially if they put a little bit of money into the units in the common area of the building, right? So you want to decide the value of that value add, right? How much can you increase the rents by? So how much is the value add? Okay, what is the actual percentage, the percentage of value add that you can add to the building every year, year over year, okay? Is it a 7% growth, okay? That's tends to be what when we look at buildings, we say, okay, well, this landlord, the rents are 30% below market value over the entire building. That's a good situation for a buyer. You're looking at that real estate, you're saying, wow, this landlord is not doing his job right. We can come in here and we can figure out how to get these units up to fair market value. And it might take a little capital, and it might take a little bit of management, better care of the tenants, better care of the finances, the who's on payroll. A lot of times they have these fat payrolls, these supervisors, and all their family members are working for them, and it's a joke. So you want to recognize where's the value add in that real estate. It can come in a number of ways, which I just described. And you want to pick up books on it really and study value add of commercial real estate, because that's the reposition key. Now, how much is that value add worth? Okay, are you going to increase the value of the real estate, the rent roll of the real estate, by 7% a year, or 10% a year, or 3% a year? Okay. Obviously, all projects are different, all businesses have different goals, but we try to find buildings that allow for a 5 to 8% increase year after year in the net operating income, okay? And that might mean getting our expenses down, but mostly getting our incomes up in different forms of income on the real estate as well. That's a really key factor. So we want to go for that 5 to 8, 10% growth every year, year after year, okay? Compounding growth there, and you want to be able to hit that mark. You don't want to set your numbers too aggressively and that you're going to knock it out of the park every single day, day after day. Now, things are going to happen. You want to, be under promise and over deliver. You want to be conservative in your projections, but realistic, so you don't shoot yourself in the foot when you go to fundraise. But for the most part, you want to say how much percentage increase you're going to do in a building. If you are looking at a building and you're conservatively estimating, once you dot your I and cross your T's, that you're looking at a value add increase of like 7% a year, meaning you can increase your net operating income by a standard 7-8% a year, that's pretty good. And you should be able to hopefully build that out. The first years might be 10 or 20%. All projects are different. This is probably 7 or 8% is a rather stabilized building that you're going to increase the rents overall about 8% a year or so. And if the rents are 25% below market value, you can look at, well, okay, naturally I'm allowed to, rents are going to go up about 2 to 3% a year, let's say. Rents are 25% below market value. If for the next 5 years I increase the rents overall 5%, take into account the natural 2%, so you're looking at 7% growth. So it's like a 35% growth over a 5-year period. Some of that's natural growth, but about 25% of that is forced growth you're going to do by better management and getting better income out of the property. So therefore, if you want 25% growth in NOI over a 5-year period, you need to raise that rent force it up by 5% a year. Okay, 5% a year for 5 years would allow 25% growth. So we really dove into the numbers there. I know I verbally went through it very quickly, but you want to figure out how much of that value add increase are you able to perform on the property in a realistic manner. And then there's a value to that, okay? If it's something like, 8% every year in forced equity, okay? Now this is not just your normal rent increases that you can do, your normal market growth or inflation. You're looking at actual forced equity, the rent or the income you can get up, the expenses you can get down. You can do this year after year, and you can get the 8% growth or something like that. Then that's awesome. There's a big value to that. So what's the value of that value? I don't know. Who knows? Every project's different. Every investor's different. Everyone has an objective mindset. This is where the science meets the art of real estate investing, because you can look at real estate and it can be close to you, and there's more value to that, and 100 different reasons why there's value to it. So the value of value add is in the eye of the beholder at the end of the day, but I want to say to you, if you are able to prove an 8% increase, a 7% forced equity increase year over year for a 5-year period or something like that in an apartment building, that's a good opportunity, and you should probably start looking to the next level of due diligence and perhaps buy that building. So at the end of the day, look for a 5 to 10% forced equity growth option in the property that, by a number of different manners. Can you get there? I'm not talking about natural market growth or natural market and rent increases, projections. I'm talking about, can you force that equity up by 8% a year or something like that, around that number, year after year. If you can, there's a value to that, and you might want to actually pay a little bit more for that, okay? What that number is up to you and your investors. Guys, it's a pretty in-depth video. I hope I didn't confuse you. If you want more basic videos, check out all our videos we make. We come out with a new one every Friday at 8 a.m. This is People's Capital Group. Our website is peoplescapitalgroup.com. My name's Aaron Fragnito. We buy an apartment building every 3 to 4 months. If you want to learn how to become a passive investor or you have properties for sale, check out peoplescapitalgroup.com and get in touch with us. Thank you. Have a good day.